Hey, hi guys. Good evening and welcome to a fresh new session of market risk modeling using SAS. Okay, so welcome Abhishek, welcome Ajaz. Before we just start off with the discussions for the session today, let's just just go and have like a refresher of the concepts that we have done, right? So in the last class, what we were discussing was we started talking about the basic sources of risk which a bank faces. And out of that, and over there, what we saw was that the three major sources of risk are the market risk, the operational risk, and the and credit risk. So basically, credit risk is the sources of risk which actually originates from which originates from the lending side of things. So basically, when a bank actually lends out to a borrower, the I mean, depending on the fact whether the borrower would pay it back or not, I mean, the bank would face a credit risk. So basically, if the borrower takes a loan and does not pay back it in due time, then we say that yes, the borrower. Then we say that yes, a credit risk has actually happened, right? So basically, a credit risk happens as a part of defaults on part of the borrowers. Due to loan restructurings and other such factors, right? Now, apart from credit risk, the two other major sources of risk are market risk and operational risk. And within market risk, we would actually explore different kinds or the different other sources of risk that are there. So, so basically, within market risk, what we saw was that there is counterparty credit risk, there's asset price risk, there is interest rate risk, and obviously, yes, there is exchange risk, exchange rate risk. So when we are talking about these sources of risk, so at each of these sources of risk or each of the sources of the fluctuations which bring about this risk, we get to see that a bank gets exposed to a different kind or a different source of risk. So basically, in the domain of credit risk, the bank faces the risk from the lending side of things. In market risk, market risk affects banks through the different sources through which banks invest into risk, right? Invest into different assets. So basically, if the bank is actually investing in the asset of some foreign company, and that foreign company goes out for a liquidation, then uh, then the market risk, or I mean, then the investment risk, or what do you say, or any kind of a counterpart or a counterparty credit risk seeps in through one particular through that investment channel. And we saw that most of these risks have been seen during the 2008 financial crisis, right? So there was a lot of interplay between each of these risks. Now, uh, okay, I'm coming to your question, Ajaz, in a short time. Okay. So basically, when I'm talking about the bank's objectives, the bank's objectives would be to actually either to there would always be a trade-off between growth and conservatism. So the objective of the bank would be to grow as well as be conservative and prevent itself from collapse. Now, coming to the question that Ejaz had posed, will liquidity risk come under market risk? Uh, Liquidity risk is something which would not be driven by the market factors as per se. So basically, a liquidity risk would not actually arise, as a fluctuation in the market directly, or the market variables directly, but it but liquidity risk may be the outcome arising from any of the sources of risk. So, for example, if a bank is lending out in a very frivolous manner without appropriate regulations and buffers in place, then if there is a huge case of default, then uh, this bank might end up with a liquidation risk. That is, it might not have sufficient funds to pay out to the depositors and may go into liquidation, right? So liquidity risk would be an outcome of the market risk, but it would not be a part of the risk, it would not be something which is caused by the market fluctuations or by the market forces per se. But liquidity risk can be a possible outcome of a specific market risk, or the outcome of a specific movement of the market factors, right? However, we would be exploring a little bit of we would be exploring liquidity risk over here as well, right? But to not that extent. Over here, mainly our focus would be based around asset price risk, which is the stock market risk, the interest rate risk, exchange rate risk, and counterparty credit risk. So in today's session, we would be, so in the last class, we started talking about what a stock market risk is, or what an asset price risk is, what are the different kinds of challenges that we might face, right? So over here today, what we would be doing is we would be exploring the asset price risk in greater details. And in tomorrow's session, we would be exploring the other three types of risk, especially interest rate risk and exchange rate risk. And then next Saturday we would be talking about counterparty credit risk. So my target would be to cover up each of these four risks and the respective modeling techniques by the end of next week. So an overview of the two. So once we have done the overview for the first 4 5 classes, then we would take up each of the risk. We would explore the different regulations in place, the core modeling techniques like value at risk, then time series models, and other associated factors, and then look into how the industry models are developed, how would the data set look like, and so on. But for the first 4 5 classes, we need to have a hang of the different risks. And then what we will be doing is, after we have explored the risks, the sources of the risk, the next part, the next way forward would be to explore the different instruments through which market risk may spread, like derivatives, swaps, options, exotic options, etc. So we would be exploring the instruments and the regulations. So first the sources of the risk, then the regulations in place, then the instruments, and then finally the modeling techniques, model development, how the validations are done, and so on, right? So that will be the way forward for the market risk modeling we that I have actually planned to. And as we proceed, if you have anything that any feedbacks that you want to give, anything new, anything you want me to discuss in details, then we can take that up as well, right? Okay, so basically in the last class we started talking about asset price risk, right? So today we will talk about different components of the asset price risk in greater details. So basically, just let's refresh as to why this asset price risk would actually occur, or when does and how does an asset price risk actually occur. So basically, what we know is that every day, so whenever there is a stock which is being traded on an index, right? So be it in India, be it the Sensex, be it the Nifty, or in USA, be it the NYSE, be it Nasdaq, so whatever. So wherever a particular stock is traded and listed, right? So for given the demand and supply, the price of the stocks keep on fluctuating, right? So any stock, so whenever we are talking about any asset, like, so basically whenever we are talking about the shares of any stocks, so there are two important concepts to it. One important part is the opening price of the stock, right? So there is an opening price, and at the end of the day there is a closing price of a stock. There is an opening price and there is a closing price, and that there is a closing price. So I'm just discussing this at a very stock level. There is an opening price and that there is a closing price. Now what happens is, now say basically a stock opens at uh, say rupees 10. So the opening price of a particular share of a stock is rupees 10, right? And so basically there is a borrower, so there is an investor who actually buys this stock. Say there is one who is actually buying say 50 or 100 units of this stock, right? Who buys 100 units of this stock. Now therefore the total opening price, or I mean the total volume that this person has purchased is worth rupees 1000. So as I would say that he has actually invested rupees 1000 into this particular stock. Now assuming that this guy is a person who buys a stock in the beginning of the day, and then he is planning to sell it off at the end of the day. So I'm just taking a very simplistic model just to explain the concept of the market, the asset price risk that is there. So basically what happens is, so say at the end of the closing, on the closing, or at the end, when the stock is closing, the stock closes at 11 rupees per stock. Given the change in the demand and supply, what happens is the stock price changes, right? Now at the 100 units, the total value of his investment is rupees 100, right? So it is 1100. So if I look into his returns, right? So this guy had invested 1000 rupees, and at the end of the day, what he has made is he has made 1100 rupees. Therefore, his return on investment is 1100 minus 100 divided by 1000. 1100 minus 1000 divided by 1000. So it is 100 divided by 1000, which is 0.1 into 100. So what he has achieved is 100%, or what he has obtained is a 10% return at the end of the day, right? So this is what the structure is. Now basically say let's look into this. So basically he has actually made a profit, and as they say that he has ended up in green. Now similarly, one possibility could also have been that the stock could have ended up, instead of ending up in rupees 11, the stock could have easily ended up in rupees 9, right? So now the total value of his investment would have been rupees 900. So basically the investment that he had made was worth rupees 1000 at the beginning of the day has actually ended up at being 900, because there has been a fall in the overall demand of the stock, or because of some news, or because of some market sentiment. The market price has, or the value of the investment has gone down to 900. Now at the end of the day, his he stands in the red, and he has actually lost minus 10% on the investment that he has made, right? Now just imagine, so this is what the market, or this is what an asset, simply what an asset price risk is. And the asset price risk is determined by the volatility, is not only determined by the average returns on the stock, but also on the spread of the average returns, that is on the volatility of the average returns, the average dispersion that the stock exhibits about its average return. So if the stock price ends up at 900, what happens is now I know that I have ended up in a loss, right? And I am unable to recover my money from the market. Now, how would this? So this is a simple asset price risk, right? Now, let us try and understand the impact that this risk can have on the market. So basically, let us assume that when this guy started, or when this guy had invested in the market, when he had tried investing in this, when he tried investing it in the market, what he did was he had actually borrowed the money from some financial institution, or he had borrowed the money from someone, right, at a given rate of interest. Now the idea was that, say suppose he borrowed say 1000 bucks from a lender at, say, a rate of 3%, right? And he had expected that the stock price, based on his expectations on and on the market forecasts, what he had tried doing was he tried predicting whether and how that the or he had predicted that he would gain on an interest of 10%, and he would pay off the 3% to this guy, and his profit would have been 7%, right? So say suppose I have a creditor over here, or a credit house. Suppose I have a creditor over here. Now, when the market actually fails to pay him that necessary return of minus 10%, there is always a chance that this particular guy might go ahead and default, right? And he might say that no, I am unable to meet the obligation that I had committed to based on that, on the transaction document. I am just unable to pay back, right? So in that case, there is this creditor who would also suffer a particular loss, right? So the impact which arises from the market, or the shocks which arises from the market, would also manifest if there is a whole channel of people who are linked to that market risk. So obviously this creditor is not directly investing into the market, but he is actually lending the money to someone who is investing it in the market. And given that there is an asset price fluctuation, right? Given that there is an asset price fluctuation, there it becomes a bit of, I mean, given that there is an asset price fluctuation or riskiness involved in the market, what would ideally happen is that this risk which originates from the investment in the asset price risk also gets transmitted to this creditor, right? And this type of a risk and this type of a transaction that has happened is a or it's a typical example of a counterparty risk, or a counterparty default risk. So where there is this guy who had taken the money basis a document, and was supposed to pay back the money back on this given date, or at this given time and given date, but given the market fluctuations he was unable to meet his obligations, and hence he defaulted, right? So this kind of an arrangement is a typical case of, it's a typical case of a counterparty credit risk. Now when I talk about counterparty risk, it is I mean it is talked about in terms of a major, I mean in a very specific framework. So where there is a so where there is a party which promises to pay a certain amount after a certain span of time, right? And that amount is due on a given date, and on that date this guy is unable to honor his commitments, right? So there are, so counterparty credit risk often arises in the process where a person is trying to hedge some kind of a risk, right? So in an attempt to hedge a particular kind of a risk, if the borrower on the other hand, on the other party defaults, then it leads to a counterparty credit risk. So I just created out an arbitrary example to create that framework and tried relating this fluctuation in the stock market to the fluctuation in the lending market as well, right? Now, this is just one particular, this is a very small case. Now try and imagine that there are many millions of lenders who are investors who are investing on a regular basis in these stock markets, in these asset prices, right? And there are a lot of people who borrow from the market, or who take up money from the market and invest in the stock market. They make their profits, they give it to the lenders, and in between they earn their profits. Also, on the other hand, there are borrowers who borrow from the banks, who take up money from the banks, and they try to invest it into a market, right? So I mean, they can subscribe to in some kind of a particular loan product where they borrow money and thereby they play it in the market. Now, the question that comes out is assessing this kind of a risk is actually very important, because this is not a very typical kind of a credit borrowing that is generally done. So, for example, if I take a home loan, I am taking a home loan to just buy a house, so that asset is known. Now, the bank knows that the bank can actually take out that money and take my home back if I default and sell it off and thereby make a profit out of it. But over here, in this kind of a setup, it is not possible, or it becomes very risky for the bank to do this kind of because this kind of investments are inherently risky, because you know that the money that you are giving out to a person, he would actually be using that to trade in the market, and in the short run the market is exposed to very severe fluctuations. Given this given this there needs to be a very strict assessment before or assessment of the fund for which assessment of the financial statements of the investors, and to check whether he has the affordability to pay back in case the market run goes through a major shock. Now, another important factor to take out is that when the investments are going in, right? So when someone is taking money and trying to invest it in the market, or some kind of a lending strategies, or lending of that type is going on in the economy, it becomes very important to understand or investigate the source of price rises, because as we had discussed in the last class, we talked about stock market bubbles, right? We talked about irrational exuberance, so we talked about market manias especially. So basically, if someone sees that the market is actually overheated, right, and if someone is willing to invest money or putting in money at that point of time, there is always a very high chance that the market might crash in a very small instant of time, and that person might get stuck with that hot potato as they call it. Therefore, when a stock price is or whenever there is a fluctuation in the stock prices, whenever there are movements across the asset prices, it's very important to assess the way the movement is actually happening. It's very assessed to look into the different field matrices that the asset is actually displaying, right? So obviously, one of a few important major matrices that we generally need to look into while we go for investments, right, or while investing into an asset price, are factors like it's not only factors which involve the return and the volatility, right? So one very important factor over here would be the return on the asset, right? The next thing that we would also need to know is the volatility of the asset, right? So there must be a volatility. We must assess the volatility of the asset. While talking about the volatility, I have different measures of volatility, or different points to where to record the volatility. So basically, one is called the open to open volatility, or the other is to measure the close to close volatility. So open to open volatility is to look into the opening price of an asset on day one, and to look into the opening price of the asset on day two, and thereby find out the returns that are possible, and thereby measure the overall fluctuation. So basically, when I talk about volatility, there are mostly two types of data that we look into: open to open and close to close. Now, basically, for data collection purposes, if I want to collect the data, then obviously it's mostly the close to close volatility figure. I mean, the close to close stock readings are mostly preferred because it is believed that the closing price captures all the possible fluctuations that has happened during the day, and is considered to be a more accurate price, more accurate figure for the asset prices. Now, when I talk about so obviously yes, there is return, there is obviously volatility. Now, within volatility, when we are talking about stock market volatility or asset price volatility, there are two types of volatility based on the time point where they are recorded, right? So one is called the inter-day volatility, or that's the day-to-day volatility. So the inter-day volatility, and the next is the intraday volatility. Inter-day volatility. The other that we talk about is an intraday volatility. Intraday volatility. Right. So these are the two volatility measures that we generally get to see over there, right? These two are very important measures. So we'll come down to greater discussions about them. The next that we have over here is which is obviously a very well-known ratio called the price earnings ratio, or the P by E ratio. Right, so it's the price earning ratio that I have. Okay, the next thing that I also have over there is so I have the price to say, so we have the dividend yield, we have the dividend yield, then we have the price to book value ratio, so dividend yield, then we also have measures like the price to the book value ratio, so the book value ratio, uh, we have dividend yield, then another important ratio that we generally have is price to book value ratio, price earning ratio, uh, huh, the GDP to market, the market capitalization to the GDP ratio, the market capitalization to the GDP ratio, market capitalization by the GDP ratio, right? So these are different kinds of matrices in terms of which we can actually assess the, you know, what should I say? We can assess the behavior of, or we can assess the asset price risk, right? So what type, so is, so how risky or how overpriced is the market, or is the market moving in a proper fashion? So then there are again technical analysis, there are fundamental analysis which are carried out, right? So based on that we can actually, so basically our objective or our idea is to assess the, first of all, assess the fundamental value of the asset, right? And try and understand that if the market is actually moving as per the fundamentals, what should be the growth rate of the market, and presently the idea is at what rate is the market presently growing. So these are the two basic questions that you need to answer whenever you are trying to assess market risk. Also, analysis can be done at a very overall level where you talk about this, right? So also another important factor which can help you assess asset price risk is the interest rate movement. How does the bond, the alternate investment instruments, how do the overall interest rate pattern in the economy move, right? Now, for example, if I think about the Indian economy at present, right? Or so basically, when you see that the overall interest rate in the economy is actually going down, right? So basically, then being a rational individual, being a rational investor, what you actually want to do is you want to shift your asset to a better mode, right? So you want to shift your asset to alternate, or your investments into alternate assets. So if you see that the interest rate in the banking sector is actually going down, then there would obviously be a tendency for one to move the money into the stock markets, right? And move into alternate form of investments, into alternate asset instruments, right? So in that way, if you see that the rate of interest in the economy is growing, then you generally see that the investments, more investments being shifted from the market to the banking sector, to the government bonds. On the other hand, if the treasury rates or the government bond rates actually start going down, then you would expect that the markets to actually grow and expand, right? Now, on the other hand, if you see that the government rates are so less, I mean, they are so less that you would always want to put on your entire money into your markets, right? And that is where you would generally see that whenever any government tries to bring in a consumption boom by affecting interest rates, so you want to expand your consumption in your economy, and for that what you want to do is you want to take a loan driven expansion. So what you do is you reduce the rate of interest on your consumption loans, and thereby you try to expand consumption. Then along with that, the side effect that comes out is those people who had invested in government bonds and government, who had the money in their banks, they prefer to withdraw the money from there and siphon the money to the stock markets. And as such, what you see is with a boom in the consumption side, the stock markets also tries, or the asset markets also expands, right? Or they also grow, and that is reflected in the stock markets. And with an increase in the consumption, right, as this consumption segment grows, there is not only a demand, with demand also increases supply, and with an increase in the supply there is an increase in labor demand, and with an increase in labor demand what you see is a growth in the average income of the people, which gets related to the and which gets correlated with the increase in the real estate boom, right? So all these features, one single, therefore you would see that interest rates play a very critical role in the stability, in the macro stability of an economy, right? So that is why this rate of interest has always been a particular technique which had always helped in to channelize investments in the in the appropriate and in an efficient or an optimal manner. Now, given this background, right? So, given this background, we'll come to the we'll explore the interest rates and the impact of the interest rates on the asset prices later on. Let's focus on most of these basic concepts initially, right? Let's understand how do a change in these different variables, how would they actually impact the stock markets, right? So basically, yeah. So basically, what happens is the to start about or to start the discussions on. So let's talk about any asset, right? Any asset A, right? At time period T, the value of the asset or the asset takes the value AT, right? Now, whenever I'm investing an asset in a market, it is identified by two things, or the safety or the security of an asset is distinguished between by two things. One is the mean return on the asset, the mean returns on the asset, which I call mu t. That is, the mean returns at tth time period is called mu t, right? And the second that I talk about is the volatility. The volatility. So the volatility is nothing but the overall standard deviation about the mean returns, right? Now, one important thing is what we need to understand is so when we are assessing an asset, right? When I'm deciding whether I should invest between asset AT or A prime T, then I need to look into the asset distribution for the two, right? So basically, there is an asset AT and there is another asset. Say I'll call it A prime T, right? So A prime T is, I mean, A prime T has some distribution. It follows some distribution with, say, mu T prime. So I'm saying that it's a given as mean and a given standard deviation. So it has its own modeling parameters, right? So AT dashed and this asset AT has mu T, mean mu T, and sigma T. Now the question comes out is how do I identify which is the more risky asset, and how do I actually go about, you know, identifying the overall, how do I go about identifying which is a better I mean which is a better asset and which is a more investable asset. So if I am to consider just the asset, the mean returns and the, and if I just to consider the mean return and the volatility, I would just look into the muti, and if I have to just take the decision based on the returns, I would just look into the mean returns and the overall volatility, right? So before I talk about mean returns and volatility, let me just define what a mean return or what a return is actually, right? So basically there is this asset T, which at time period T, the price of this is PT, right? So generally we consider this to be the log of the price. Basically, since returns are decided, I mean, since we talk about returns in terms of the percentages, right? So basically, it is always easier to transform the variable or transform the price series into the log versions, right? So the log of the price P at time period T is small pt, and price T minus 1. So the return at time period T will be the price today, that is at time period T, minus the price that was yesterday divided the price that was yesterday. So basically it is like log of the price in time period T minus 1, right? So the returns or the log of the returns RT is defined as log PT minus 1 by log PT divided by log PT minus 1. So there is a minor error that I have done. This is log PT minus PT minus 1, right? So this is what the return series is. So this is how we generally define a logarithmic return, right? Now, having defined these returns, the next thing that we need to know is what exactly is the volatility of the returns, right? Now, if I compute the returns over a period of time, obviously I will have an average return, or I will get a long run mean returns, right? I'll get a mean return. So the question that comes out over here is that, so for a return series over a series of returns taken over a point of time, say weekly returns, monthly returns, annual returns, so I will get an RT bar, or a mean return. Now this mean return can also be thought of as a stochastic variable. So we'll talk about the formalizations a little later. Let's not talk about that. So basically what I'll have is I'll always have a mean return, right? I'll have a mean return. I'll have a mean return, right? Now from this mean return, using this return series and the mean return, what I can do is I can compute an average variability of the returns. So I can compute an average variability, which I will call the volatility. So this volatility is defined as root over 1 by n minus 1. So where n minus 1 stands for, the n stands for the number of the trading sessions, right? So this divided by RT minus RT bar whole square. So this will be your volatility, right? So where n stands for the number of trading sessions that we have had over a given period. So if I'm computing weekly returns, then it shows the number of trading sessions that I have had over the entire week, right? Based on close thing. If I'm computing monthly returns, it will show me the monthly sessions, the number of monthly trading sessions that I have had for that stock. If I'm computing annual return, it will show me the number of annual instances where the trading has happened for this stock. And based on that, I'll get the overall return and the overall deviation about this, right? So basically, so over here, this gives us an idea about the overall variability of the behavior of a stock. The overall variability. Right. So these are the two basic metrics in terms of which I need to identify which one or which would be a better stock in which to invest. Now for doing that, so let's graphically look into that which one would be a better stock. Now, one very important factor is, or one very important characteristic of this is, especially in asset prices markets, are greater the, you know, greater the risk of a stock, the greater is the returns of the stock. Therefore, the higher the volatility that you get to see, the higher overall spread that you get to see, you know that higher is the return associated with the stock, right? So what we'll do is let's just look into this phenomena graphical. Right. So after this, so basically over here what I'll have is so over here what I'll have is I made a mistake. It's not the price. It will be the time, right? So I'll have the trading sessions or the time over here. Right. Over here what we have is the returns. Over here I have the returns. Right. Now let's have a look into this. So basically what I'm doing is so I have one. So this is one particular stock, right? So over here, so this is basically the mean returns associated with this stock, right? And then I have another stock over here. Right. So over here, if I have a look into this stock, into the distribution of this particular stock, then what I'll see is that this is no, sorry. I have a stock over here, right? So basically, what you get to see is that. So let this be your A. So let this be the stock 80 or the asset 80, and let this be 80 dashed. So what I can clearly see from here is that even though the mean returns for both these stocks are more or less the same, right? But the spread of the returns for this stock 80 is much more than the overall spread of the stock for 80 dashed. So therefore the variability in the returns for this stock is particularly much higher, right? So basically even if I have a higher, so basically given the returns, right, I would always opt for 80 than 80 dashed than 80, because the spread of the returns in it is relatively more connected. I mean that is relatively more it's more concentrated, so the spread is relatively less for 80 dash compared to 80. Since given this spread, what I can conclude is that the variability in the returns for 80 dash is relatively lower than that of 80, and hence what we would expect over here is that yes, 80 dash is a relatively less risky stock than 80, right? So therefore only looking into the mean returns would, so if I actually look into the mean returns, I would say that I would be indifferent between the two stocks. So looking into the mean returns is not only important, but also what I need to do is I need to look into the overall dispersion that is there, right? So this is how we, this is a very simple example where I am just looking into both the returns and the volatility, and I'm taking my decision on it. Clear? Okay, so I'll just take a pause and I'll take up any questions if there are any. Great, great. Okay, so let's move on. So basically, having discussed this, the next part that we have, or the next part that we uh, talk about over here, will be that, yeah. So the next question that comes out is that if I am to think about uh, modeling this return, modeling this volatility, so how is it that I can, statistically try to model this particular variable? I mean, how is it that I can actually model the returns of a variable? How is it that mathematically, I can represent uh, the returns scenario, right? The returns of from an index, and given that, how is it I can incorporate the impact, or how is it that I can incorporate the riskiness involved with asset prices, right? So basically, to represent the return path, or the path of an asset, path of an asset returns, right? So there is a very famous equation called the Black-Scholes equation, or the Black-Scholes model equation. There is a very basic equation which has been used across the domain of risk, right? So this equation, that I am about to discuss now is a part of the Black-Scholes model, model of option pricing. Now, it initially had started off with the price of how would an option price look like. We'll discuss that when we come to option pricing. But on the other hand, we would also need to, but we would also get to look into how is it that so this, how has this equation changed its faces as it has gone. So it is used to analyze the return patterns. It can be used to analyze, or rather, it has been used to analyze the asymptotic single risk frontier model, which is the backbone of Basel, right? It is used to understand different respective market shocks. So this equation has a very versatile usage, and even though the Black-Scholes option pricing model talks about a lot of different aspects and brings in a lot of complicated equations into one place and solves it, but the basic identity of the Black-Scholes model remains very simple. So I'll be adapting that framework over here to explain this volatility and the asset price risk, right? Okay. So, so basically, one thing we have seen is that every asset, right, over a given period of time, will have an average, right? So it will have an average return, and it will have a volatility. Now the question that comes out is, now if you observe, this mean value is more or less, you know, it changes with time, right? So over time, as time changes, the mean value it follows more or less a similar value until and unless there is major change in the behavior of the stocks, etc. On the other hand, volatility is a very random pattern. So now, if I want to understand the return structure, right? So how does the return of stock price changes? So over here, what you can see is that return is defined as nothing but, if I write it in words, return from an asset is nothing but the percentage change in the price of an asset. It is nothing but the percentage change in the price of an asset. Change in an asset price. In an asset price over a given period of time, right? So the question that comes out is, how do I change, how do I represent this asset price change, right? Now over here, what I get to do is, I write it as dp by p. So dp is nothing but, dp shows the change in price. So this is for discrete changes, right? So where there is a time t and there is a time t minus 1. Now if I am looking at the stock price over a continuous time framework, say, if you think about the stock market tickers, right? So it changes every second or in every microsecond. So the path through which the stock market evolves is actually a continuous time frame. It is not that it changes now, it will change after 1 minute, it will change after 2 minutes. So it's not a discrete framework. So the way the stock market would actually change is in a very continuous framework, right? It would change in a continuous path. Now, when it changes in a continuous pattern, right, then I cannot actually use this kind of an equation to show it, because over here, this equation is valid only if time, the variable t, is taking discrete values, values like 1, 2, 3, 4, 5, 6. Only then can I put it in this format. So if I am looking into the return between substantially large period of time, say the price today and the price tomorrow, I know there is a discrete change in the date. Today is 1, tomorrow is 2. So I'm not taking into account then the continuous changes in the prices, right? So over here, however, if I want to actually create a path that the returns of an asset or the asset price would follow, what I need to do is I need to look into the continuous time frame. So every second or every microsecond, how is the price of an asset changing? So it is there that this percentage change in price, this dp, comes into play, right? So this dp shows the percentage change in price in a continuous time frame. Clear? Now this percentage change in price is affected broadly by two factors. What is it? One is the mean returns of the asset at time t, right? dt. Now what this dt stands for? Dt stands for change in the time, right? Dt stands over change in small or continuous periods of time. So basically what I'm trying to do over here is, I'm trying to say that the percentage change in the price t is, I mean, the mu t will change as time changes, right? So the mu t is more or less obtained from a distribution, right? Now, now this will change with change in time. So the percentage change in price, right, is composed of two components. One is the variation and the other is the mean returns. So the mean returns is changing over time. So this shows the impact on the change in price with changing in time. This shows the total mean effect of the asset. Now with this, what I have is a variation or a volatility called sigma t, right? Now comes the most tricky part of this entire equation. Till now everything was more or less deterministic. Mu t was a fair value in the distribution, sigma t was there, and mu t was changing with time. So that till now so far so good, right? Now basically what this shows is over time. So if I look into this percentage change in price with respect to time, then it is the mu t becomes a constant factor. So says that the price changes at a mean rate plus minus a fluctuation. Now the sigma t or the volatility is actually a random concept, right? So there is a stochasticity involved, there is randomness. So but over here the sigma t that I get to see is a constant value, or it is obtained from a distribution, but this sigma t is random. So the path breaking fact which was introduced in the Black-Scholes model was the Wiener process, the DW. Now this DW that I am talking about over here has been the, this is the most interesting and the most dangerous part in a financial time series or in a financial equation, and it is this DW which is creating all kind of stochasticity, right? This DW is called the Wiener process or the Brownian motion process, and it is this Brownian motion which is creating all changes. The moment you incorporate this DW, now what is this DW, what is the Wiener process and all, I'll come to it. The W is the Wiener process and the DW shows the change in the Wiener process, which is absolutely random in nature, right? So over here this sigma t was initially a constant. Now to that I change a random fluctuation or random change. This is called the sigma t dw. Now when I talk to you, when I see this equation now, the introduction of this Brownian motion, this Wiener process, had changed the entire expression. Now this volatility has become a stochastic factor, it has become a random factor. So over here what we need to understand are the following. First, what is this mu t over here? I'll just change the ink to this red. This is the mean, right? This is the volatility. This is the volatility or the average fluctuation. Right? And over here what we have is this dw, the w is your Wiener process, is your Wiener process. Right? Now this Wiener, so before I move into discuss the Wiener process, I'll discuss Wiener process separately now. So but before I move into this Wiener, explaining Wiener process and Brownian motion, uh, can you just tell me like up to this point till before Wiener process, is it clear? This path, equation of the path and everything, is it clear? Then I'll take up the Wiener process separately. Okay. Okay. So that's a good question, Ajas. Why are we multiplying it with dt? Okay. So basically, what Ajas wants to understand is that, so what you want to understand is that why is this mu t being multiplied with dt? Now let's take this case. Mu t is, say mu t is suppose 200, right? Okay. And say suppose dt is changing, and dt shows the change in time. Let's suppose dt is 1. So it means it has changed by 1 unit, right? So what is the mean value after the time has changed by 1 unit? So the after the mean value has changed, after time has changed by 1 unit, the mu value is mu t into 1. So it shows the mean value is 200. So similarly, if dt is 2, then mu t is this value mu t star 2. I'll say that the mu t is 400, right? So the average, so this assumption or this structure basically shows that the mean, the mean returns changes proportionately over time. The mean returns changes proportionately with time. Proportionately with time, or with the change in time. Right? So mu t dt shows that the mean over there, the mean returns of the asset changes proportionately with time. So it's just a, so the return is, the mean return is constant, and if time period, if it is 200 today, it will be 400 tomorrow, day after tomorrow it's going to be 600, and so on. So after a period of time, when whatever your dt is, your mean returns will change with respect to, will change proportionately over time. Clear? Adjust. Great. Great. Now the next thing that we need to do is, so therefore the similarly the sigma t over here is being multiplied with this dw. Now it says now this dw is the Wiener process. This is the so this is the part which creates the entire stochasticity or randomness in the price. I mean in the entire market, right? I mean in this entire dynamic. So this is the part which creates the randomness, right? Now the point over here is that this is creating a randomness, right? Now, when we had talked about linear regression or when we talk about time series, we also talk about an exogenous random term, epsilon, right? But over here we are not including that. So what would be the exact difference between randomness and what we call the white noise error term? So this is what we look into next. Just give me a minute. Okay, fine. So basically, when we talk about Wiener process, right? It talks about, so what we are talking about is randomness. Now let's try and model in our minds this concept of randomness. So how do I figure out, how do I talk about, how do I picturize a random event? How do I picturize the movement of a random event? How do I do that? So that is something that we need to understand. So over here, what you do is, so the next part that we talk about is modeling randomness, right? Now, if you do not understand anything in this part, feel free to reach out to me, right? Feel free to stop me and ask me, because this part in market risk is very critical. So over here, what we are talking about is randomness. Randomness. So for randomness, so if I try to plot it on a graph, right, how would a random movement look like? Say suppose I am trying to plot it on a graph, right, and say this is the time, right, and there is a movement, right, so I'll call this variable xt, and my assumption is that xt is uh, you know xt is a random variable, and it does not have any equation. It is absolutely random, it is absolutely stochastic, so you just cannot model xt. So my first presumption over here is that xt starts from 0. So this is a very simplistic assumption that I make over here. Xt can start from any point, but I'm assuming that it starts from 0, right? Now in the next time period over here, which I believe is 1, I see that xt takes a path out over here and comes up to this point. right? Now, can I say that from here xt will in time period 2, which side will xt move? So given that xt has evolved from 0 to this point in 1, does it necessarily imply that in the next additional increment x2 will grow over here? Does it necessarily imply? No, because it is absolutely random. So ideally, what it can do over here is it can actually evolve to here, or it can evolve to here. Excuse me. Or it can evolve to here, or it can evolve in here. So I don't know that, given that it has evolved from here to here does not ensure that this will evolve from here to here, because there is no rule that this particular variable xt is following. So that means this increment, say I call it delta 1, right? Given that I call it delta 1, this increment cannot predict the next increment that it is going to have. So very possibly, say what we see is that this is the increment that actually happens. So it actually traces this path and it goes up over here. But observe that this increment from here to here and from here to here is absolutely independent of each other. So there is no idea that I cannot frame an idea that, given that it has evolved from 0 to this point in one time period 1, will mean that it will evolve from 0 to this period 2, because it is not following any rule. That means the next increment that it has shown over here, this increment which I call delta 2, is absolutely independent of the increment that has happened over here, right? So if I say that, so if I try to calculate the probability that delta 2, say this is called point A, this is called point B, this is called point C. If I try to find out that what is the next increment will be at point B, given delta 1 was at point D, given that delta 1 as was at point D, the probability that I will get is that these two increments are independent of each other. That is, it will be delta 2, probability that delta 2 is equal to B, into the probability that delta 1 is equal to B. Right? So this is what it would be. So I'm multiplying the two probabilities, because so if there is event A which is conditional on event B, right? And say suppose if event A and B are independent of each other, then the probability of A given B is nothing but probability of A into the probability of B. Right? So what I basically say is that if there is a process which is a random process, right, then the very basic idea is that its successive increments will be independent of its previous. So given that it has moved from 0 to D, I cannot use that to predict that it will move on to point C. It can actually move on to any possible points, right? So this entire point that I have over here is that the successive increments are independent of the previous increments, right? Now, such an event where your past events cannot predict your, you know, the information on your past occurrences cannot be used to predict your future. Such a information structure or such a model is called a martingale model, right? So where, so say suppose you have a sequence of events happening. So event A happened, B happened, C happened, D happened. Now the occurrence of event A cannot be used to predict event B, and occurrence of event B cannot be used to predict event C, or the occurrence of C cannot be used to predict D. So if none of the past events can be used to predict the next future event, then that event is called, or then that model is called a martingale model, right? So even the past events will never help you predict the mean in the future. Therefore that kind of a setup is called a martingale. Clear? So a randomness or a Wiener process, as I said, is also called a martingale, right? So this Wiener process is also called a martingale. Now, martingale is something which is very frequently seen in model development documents of market risk. So basically, if you actually go through any of these, any of these model development documents where a lot of these risks have been done, or in fact, if you go through the basic, you know, the background of the the Basel documents where you have these calculations of risk weighted assets created and all, there you see that it is the randomness, that process is a martingale process. So it has already, it, it already called, it already has been used in, this setup is also used extensively into the risk domain, right? So to model the systematic risk. So obviously, so randomness is a phenomena, or a randomness of the Wiener process is a phenomena where, all the successive increments are independent of the past. That is, a past increment cannot be used to predict the future increments, right? So that is why this process is also called a martingale, right? And the Wiener process follows a distribution of the following type. Hold on. Yeah, and the Wiener process is, therefore, the Wiener process that I have been talking about. It is nothing but, it's a random variable. You can think about it as a simple random variable which follows a normal distribution with a mean 0 and a variance t. T as in the time period, right? So basically, the variance keeps on increasing with time, right? And you cannot actually predict the variance. So basically, it follows the mean with mean. It follows a normal distribution. Given that it follows a normal distribution with a mean 0 is enough to identify that it's similarly kind of a white noise, and it has a specific property that the past increments are not in a position to explain the future increment, right? So the future cannot be explained using the past. So that is what the overall idea of a Wiener process is. So this Wiener process is nothing but, it is used to bring in the randomness, right? So what it says is that you cannot actually, form an estimate of the change. So what is exactly the change in the minor process you cannot, or what is the change in the volatility that is exactly it is going to be, you actually cannot find it. What you are saying is, so this minor process, this brings in the randomness, right? And when you are multiplying that volatility with this randomness or this change in the value, so if the change is now by plus 2, it is not necessarily it will be by minus 2. So it's plus 2 now, minus 0.5, then plus 3 now, then again minus plus 2, then plus 3.5. So it can be any changes. So the past history of the changes will not allow you to form an idea of the future changes. And that is why when I'm multiplying it with volatility, I'm making the volatility something very stochastic in nature. And why is that volatility in that asset price path stochastic in nature? It is stochastic in nature because this volatility is driven by a lot of random factors like speculation, market sentiments, irrationality of the agents, bounded rationality, and stuffs like that, which are not actually estimable in nature. So there are a lot of human instincts and human behavioral factors affecting the volatility, and that is why it is so random in nature. And this is how this randomness has been incorporated in the price path. And it is this Wiener process which makes the price path stochastic in nature. Clear? Abhishek Ajaz. Great. Okay, anyways, I'll share over this recording. I'll share over the last class's recording as well. I did not get time this week. I'll do it this week. I'll do it tomorrow itself. I'll share over these two recordings so that you can start going with it. Thank you, Ajaz. Okay, okay. So having seen this, the next part that we need to talk about is okay. So then, this is how it shows, right? Now, obviously, the Wiener process shows a kind of risk. That is, so the riskiness in the asset price movements or the volatility in the asset prices, or this what I've been calling the stochasticity, has been captured through this particular path, through this particular part, right? Now, now the question that comes out is that what are the different extents of the risk that I can uh, have. So one riskiness is over here, and there will be an average movement, and there will be an average fluctuation about the mean value, and that's all right. But the asset price risks also come in a major magnitude, right? In the form of shocks. So over here, so if I look into this part, so let's consider this framework, right? dp by p is equal to mu t dt plus sigma t tw minus k dj. Now this is a twist in the entire story, right? Now this shows a sudden shock in the market price. I mean, in the market value. This shows a sudden shock. where this dj that I have created is equal to 1 if a shock occurs. If a shock occurs. So basically, say there is a market crash, or there is some externality, or there is sudden discrete market correction which causes the stock prices to fall. So this shows DJ if a shock occurs. Equal to 0 otherwise. Right? Now just imagine that what if 1 or DJ equals to 1 occurs. Now if DJ equals to 1 occurs means DJ takes the value 1. That means a shock has actually happened. So if a shock happens, the moment this shock comes in, the asset prices fall suddenly. So there is a discrete fall in the asset price, right? This is asset price risk. So the moment this shock or this event happens, there is a sudden fall in the stock price, right? And the stock price falls discretely in a discrete manner. It suddenly goes down by the value. So there's a jump in the stock price, a negative jump, which is a crash, and the entire equation just goes down. So say previously when DJ was 0, the stock prices were going at a certain price and at a certain volatility. Suddenly there is a news coming in, a stock market flows in, and it falls. Now the moment this happens, there is a shock that has happened, and a discrete amount of investment is lost. Because say previously you had been investing around invested stock which was 10 and it was fluctuating around 9.5, 11, 9 to 11. Suddenly a shock comes in and the price just goes down to 50. It just directly falls. Now what will happen is everything else remaining unchanged, you have lost out half of your investments. You will not be able to recover more than 50% of your investment. Now this is the shock that happens when your stock markets go through crashes, right? So this is what happens when suddenly a stock market bubble bursts. This is what happens when a real estate housing bubble bursts, right? And with the experience of the with the previous experiences that we had seen, uh, over a span of time, most of the economies have regulated the housing markets, and they have held the loan to value ratio of the houses at a given, at a good 75-80%, so that that the loan amount does not exceed the equity value amount. So one thing we can clearly see over here is that yes, this is what, or this is precisely what would happen if a market crashes, right? So the market actually falls down by a limit. Now this k that I have over here, I have fixed it at a given value. I have said that okay, there is this stock price, there is this stock which I mean the market loses out a fixed amount of amplitude, but going forward you can also lose out even further. So this k can be constructed through a distribution and stuff. I'm not getting into that, right? So what I'm looking over here is into the fact that yes, there is a possibility that uh, you know that the market, so if a market shock like this happens and the market suddenly collapses, and then the shock that I get in terms of investments etc is called the asset price risk. This is how the asset price risk actually occurs, right? So as the market comes in a close vicinity to crash, right? So you know uh, so it can even be seen that that this probability of the market to crash, this is what we call the crash hazard rate, is something which also controls the mean return over time. So this is something that we can also investigate. But like what the point that I want to make over here is that this market shock comes in as when the market just crashes, just a sudden shock comes in, and the stock price loses amplitude. This is what actually happens, and this sudden fall in the asset prices is what creates the asset price risk. Right. Now if I think about it in this way, then I can also say that this has significant impact on the credit risk as well. So generally when we are developing credit risk models, we treat them in solidarity. We remove all market risk variable and all. That is because just to assess that part of the risk which is stemming from the borrowers or the transaction risk. But if we think about it in a manner, guys, we can actually see that the impact of market risk and credit risk to some extent is actually related. Let's take the case of say a firm which finances the real estate business. Okay, let's take it like this, and let's rewind time and let's go back to a period where we are standing as on 1st January in the year 2008. Right now, all the credit risk models which have been built prior to 2008 are in place, right? And all the PD estimates, LGD estimates, or EAD estimates are there in place. Now, so I have standing on 1st January, I have run the models and I have calculated the expected loss, expected credit loss values. And what I have seen is that yes, over the next 12 months, this is what is the expected loss that is going to be. Now, now I know that okay, the obligors are working in a proper way and all. Now what happens is the housing prices start crashing. The moment housing prices start crashing, the builders or the real estate owners to whom I had given my funds or to whom I've lent out are unable to sell their houses. As such, those sellers who used to have huge amount of cash flows a few months back are now unable to meet that demand. I mean, they are unable to get any cash flow because the bubble in the housing prices have bursted, and the market and the borrower there has been huge defaults, and given that a lot of houses have been built up, people are now no more buying it, and hence the cash flows of these people have dried down, and now they are unable to meet my expenses, and hence what happens is my expected losses starts rising. Therefore, the expected loss models which I had built and had implemented in the year 2007 actually goes for a toss, because now there has been a sudden macroeconomic shock which has actually impacted, and this macroeconomic shock has in a discrete manner increased the has in a discrete manner uh, you know resulted in the discrete deterioration of the standards, the financial standards of the obligors, and hence their credit ratings have degraded in by a notch or two. There has been a sudden fall in the credit rating, and as such, there has been a spike up in the expected loss models. Right, therefore, the expected loss, the provision models that I had made have thoroughly underperformed, and I know that my provisioning and my model has been thoroughly under provision. And as a result, what has happened is my models fail. Right, so the lack of incorporating such an exogenous shock into the expected loss models often make them very sensitive to such macroeconomic situations. Hence, keeping this in mind, the new IFRS 9 model, the new set of IFRS 9 models which have come up, when they actually predict the expected loss models, what they are when they are trying to predict the expected credit losses, what they are trying to do is they are trying to assess the
quality of the loans under all three conditions, right? And under different stages and under different macroeconomic scenarios, and they see what how would the what would be the possible expected credit losses if there is a there's an average economic condition prevailing. What if there are adverse situations, what if there are severely adverse situations, and how would the borrower's behavior, lifetime behavior changes, assuming that they face all the three conditions at a given at different points of time in their loan lifetime. So under these situations, these expected credit losses are being impacted because when we used to have the previous provisioning order, like be it the fast the financial accounting standards or the previous versions of the international accounting standards, or be it the Basel like the using the Basel expected loss framework, we did not take into account such exogenous macroeconomic shocks, and hence a lot of these expected loss models, a lot of these allowance for loans and lease loss models had actually failed in times of the recession. And if you actually do a backtesting exercise, if you go back and you look into that and you create a backtesting kind of a framework, you would see that the expected losses that your models are giving through PDLGD scores are much lower than what the actual charge-offs had been. That is why the loss rates of the portfolios have spiked up during the during these downturn periods, and the models could not actually predict it. It was because of this sudden shock factors coming into play. Clear? Anything to add on, Ajas, to this, if you would like to? Abhishek, are you getting this? Okay, great. Okay, fine. Now, okay, so this is what more or less the asset price risk is, right? In the next class, that is tomorrow, we'll talk about, or we'll discuss the other different types of risks. We'll talk about interest rate risk, exchange rate risk, counterparty default risk, and if something else comes up, so I'll create a summary of the asset price risk, and we'll have a discussion on the other three other different types of risks. Clear? Okay, great. Okay, so let's meet again tomorrow, guys. Thank you, everyone. Thank you for your time. Let's meet tomorrow. And in case you have any queries, any questions you want to ask me, feel free to get back to me. Thank you and good night.